Good morning. I'm Michael Henley, the CEO of Brandywine Oak Private Wealth, and I'm joined by Peter Kim, our Chief Investment Officer. We're going to talk about what took place in the second quarter this year. All right, Peter, to kick things off, it's been a very volatile quarter. So early April, we saw, a 20% drop in the S&P and then a 20% recovery. So kind of talk us through what's going on.
It's pretty incredible if you think about it, right? I mean, starting April 2nd was Liberation Day, I guess, whatever it was called. And we saw the markets basically in free fall. Then we had a protracted trade war, which lasted probably about a week and a half until they kicked the can down the road with tariffs. Then we slowly saw the market kind of recover with the taco trade of Trump kind of continuing to kick the can down the road and making more carve-outs for tariffs.
The taco trade, so remind us, what does that stand for again?
Trump always chickens out.
Trump always chickens out, okay.
So I think part of it is one side is saying, yes, he's always chickening out and delaying things. The other side, this is part of an active negotiation. Basically the same thing at the end of the day.
Okay.
But it kind of helped push the markets back up to all-time highs. And now, again, we're kind of priced for perfection of everything kind of lining up. Hopefully it can to kind of keep the markets going forward.
Okay, got it. All right, Peter, so just talk us through markets. What, S&P's up 5% or something?
Yeah, roughly about 5.5% for the year.
Okay.
So it's good to see that it's positive given how much of a decline we saw at the start of the quarter, which is great. So we're fully recovered and now positive again, which is great. International markets, though, have been the bright shining star. International markets, if you include the U.S., we're up roughly 16% for the year. International markets without the U.S. are closer to roughly 18-19%.
Okay.
So it's good to see that global markets do have some value. Diversification does work, and you're able to capture some market returns, even though the U.S. may not be doing as well in the short term.
Got it. Okay. Talk us through the situation with tariffs. And basically, they're delayed right now. Is that the expectation they'll come back in the fall, or what's going on there?
We'll see what happens. I think what the biggest event-driven scenario that we saw was tariffs being put on, then tariffs being taken off, and kind of quasi half on, half off.
Yep.
So we'll see what happens. July 9th is kind of the due date of when it's supposed to be expiring. The administration has already come out and said that that date is kind of arbitrary and that doesn't necessarily mean anything to them. So I expect them to kind of continue to kick the can down the road, especially if they have the negotiations that are currently ongoing. You can easily make the case, this is a good situation. We're currently in active negotiations. We can delay these tariffs again as everyone's acting in good faith.
Got it. And this week, the Senate just approved this new tax bill, this big, beautiful bill, as they call it. So any thoughts there on kind of what markets, I guess, kind of pricing that in?
I think the markets are kind of pricing it in. I think it was a foregone conclusion that it was going to pass. It was just a matter of how big it would actually be and how all-encompassing. It seems like it has pretty much everything that the president wanted in it.
Yep.
So now it's just a matter of how much of an impact is that really going to have in terms of the vast array of other things that are currently kind of up in the air, right? So you have tariff negotiations, the Fed, and whether or not they're going to cut interest rates.
Yep.
Inflation is going to spike. What's the labor market going to do? I think it just adds to the general unknowingness of kind of how that's going to impact the debt.
Got it. Okay. So talk us through, Peter, international markets. Europe was in a recession, right? So what's going on there?
Sure. So Europe probably bottomed out at the end of 2024. And when you see kind of where they've been and what they've been doing from a central bank perspective, you're seeing the fruits of that kind of work. They're aggressively cutting rates. I think their inflation rate in the Eurozone just hit 2% for their target number. So they're well ahead of where we are. Their average central bank rate is way lower than what the U.S. is at this point. And then you also have the ongoing Trump 2.0 scenario with NATO now kind of increasing to 5% spending.
Yep.
That's going to be another boom for their general economies. Is that's going to be general dollars being spent somewhere in their economy at some point. So I think Europe has a lot of optimism kind of going forward.
And specifically, the foreign markets are still a lot cheaper than the U.S., right, on the valuation basis?
Absolute valuations, yes. Obviously with the run that the international markets have had, that gap has kind of closed a little bit.
Okay.
But yeah, on a pure price basis, I'd say Europe is still kind of a better price to start from than where we are right now in the U.S., especially with the markets being back at all-time highs.
Got it. Makes a lot of sense. What is the latest on the Fed? Every time we turn around, we hear Trump giving Jerome Powell a hard time about rates being too high.
Yep.
Now, what's going on there?
Sure. So obviously Trump wants all the rates to be much lower. Fed Reserve, Jerome Powell, they're much more hesitant and a little more cautious. I think probably they could cut. There's some room to cut when you look at kind of how high we are from an interest rate perspective versus kind of where the general kind of natural real rate is. But I think they're very worried about what the tariff impact is going to be. It's a delayed impact, so it's probably 3 to 6 months before you really see that. So it's maybe right now before you really start to see the impact of tariffs. It's like they want to see how much of an increase is that going to be in terms of inflation. We offset that with declining energy costs. and rolling off of real estate rental prices, kind of naturally declining the inflation rate to kind of offset it.
Okay, got it. Talk us through this for the viewers, the first quarter negative GDP print. And that was kind of talked about a lot, but kind of talk us through what actually happened there.
Sure. So GDP is basically consumption, consumer spending, government spending, and then net imports and exports.
Yep.
Right. So basically, you had this onslaught of tariffs that were coming at 150% plus or whatever the numbers were. Everyone was trying to front load that and get all their orders in way before that.
Okay.
So the problem is when you import a bunch of stuff, that's a negative technically to GDP.
Okay, so it really wasn't an economic driver. It was more just public company CEOs accelerating their purchase of their imports.
Exactly. If this tariff's really going to be in place, we need to front run this. We can buy it for cheaper right now.
Okay.
Let's just do it in advance, and then we'll just delay buying stuff until we, exhaust all this inventory.
Got it. Okay, that makes a lot of sense. Give us an update on our portfolio models. Kind of what's the latest?
Sure. So portfolio models for us, thankfully, because this was an event-driven kind of event and the volatility was kind of self-inflicted, we didn't really react to it and change our models in any meaningful way. We've continued to let them strategically just grow and drift up to their target allocations, which we're kind of at now at this point. But because we were so regimented and disciplined in doing that, it created a lot of flexibility for us to take advantage of the volatility to say, hey, we can do some Roth conversions for clients where it makes sense, or we can tax loss harvest for clients where it makes sense if there are losses, and do tax swaps. So they captured all of that upswing then as well.
Got it. We always like to say the market has a way of surprising the largest number of people, right? And it's funny, last year coming into this year, no one expected foreign markets to be up double digits, gold to be up 25%. I mean, and the S&P to be kind of flat to barely positive.
It was very much going to be the continuation of US exceptionalism. And then it was very much US exceptionalism is done. This is the decline of the US. Trump's going to lead us over the cliff. And now it's, well, maybe not so much anymore. Everyone can be good at everything. And it's just kind of revamping what the trade world looks like.
Got it. So, makes a lot of sense.
We'll see what actually happens.
Okay, makes sense. As you know, Peter, every quarter we talk about the 8 laws of investing. This quarter, it's law number 8, which basically says that you're not properly diversified unless something in your portfolio is down. So something should always be down. Now, as an investor, that's kind of difficult. Why should I have a negative asset class and hold it, over time? Kind of talk through that, how that works.
Sure, absolutely. So this is kind of the foundation of asset allocation models and modern portfolio theory. I would definitely recommend people look at our quilt chart we've attached to the newsletter, because it shows through the last 2 years of quarters what each performing asset class did.
And that's a very telling chart, because really, I think what everyone would expect to see is kind of large cap stocks to be dominant every quarter, and they've only been best performing asset class a couple quarters, right?
It's very surprising. There is a world of randomness to it, which is nice. But when you think of portfolio performance, if everything is going up together, it's great. Then the other end of the spectrum is everything's going to go down together at some point too. Yep. So if you have different asset classes that are doing different things on different return cycles, you're narrowing the band of possible outcomes in any given year. You're also creating a much more consistent return cycle then too.
Got it. So you always want to maintain disciplined diversification.
Exactly.
Got it. Okay. So the second half of the year, Peter, would you expect volatility to be higher than normal, just given the backdrop?
Probably, right? I mean, if the first half's any indication, I'd expect the second half to probably follow suit in some way, shape, or form.
Okay.
We probably won't have that free fall off the cliff like we had in April 2nd. But at the other end of the spectrum, right now, when you look at the markets and the way that everything's valued, we're kind of priced for perfection again all of a sudden. You need everything to line up. You need all of these trade agreements to come into place. You need Israel and Iran to have some sort of resolution. You need Ukraine and Russia to have some sort of resolution. You need China to come to the table with a true agreement at this point. You need the housing market to kind of soften. You need the Fed to cut rates.
Okay.
All
this to happen. Okay. Got it.
And then, yeah, absolutely, we can continue to see growth. But if any of those start to falter in any meaningful way, you could probably see some bumps in the road as the market tries to settle that out.
Okay, and historically for the Israel-Iran conflict, geopolitical uncertainty, how has the market typically behaved under that environment?
So historically in the past, it's been a much bigger deal for the oil markets.
Okay.
I would say recently, last 20 years or so for recently, it's been less of an impact just because the US has become such a big oil producer.
Okay.
Right, so now Iran is roughly like 12% of the world market share in oil production. It used to be a lot higher. Now oil is not as big a commodity for us that we needed because we have so much production everywhere else.
Got it.
So they're limited scope in terms of how much impact they can have.
Okay, terrific. Well, thanks everyone for joining us again. Really appreciate it. Thanks, Peter, for being here. And if you have any questions, reach out to Relationship Manager at Brandywine Oak.